Ladies and gentlemen, thanks so much for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and we're very excited for today's show. We have Luke Hoersten joining us on the other side of the mic from Bitnomial. This is continuing our theme, I guess, of the year of having new faces join us on the program, but new faces to the show. These aren't people that have just come out of nowhere, right? And Bitnomial is a good example of that. We just recently had a number of venture funds that have been operating, and I've known these people for years, but they've never come on the show. And it's about time Luke got on. It's good timing because you just got all of your regulatory ducks in a row, so to speak. I know you've been trying to crack this egg for a while. Maybe I think we could say you were a bit too early to on exchange derivatives in crypto, but now the market is exploding. We're probably going to see a bunch of things are going to get weird, so to speak, now that the ETFs are on board, whether that's going to be options or other different types of derivatives on top of those products. And then, of course, we're seeing indexes across the board. I mean, even at the Block, right? You know, we've partnered with Bitnomial on an index firm and have launched our own index that covers the top cryptos in the market, as well as our own meme coin index. So there's a lot of things happening. But let's just start with the basics, Luke. For folks who are maybe unfamiliar with the firm and its origin story, break it down for us.
Yeah, so we've been in the space for quite a while, and
2018.
Yeah, I think even earlier than that, maybe 2016. So we've been at it for quite some time. And a lot of us come from the proprietary trading space, trading anything that's listed globally. So, you know, what was probably formerly called high frequency trading, technology driven trading. And when crypto came out, well, specifically Bitcoin, a lot of us were trading global commodities, FX, things like that. There was a lot of geopolitical risk and unrest at the time. And I remember specifically in kind of the 2014 time period, FX was going crazy. You know, we were trying to reduce our exposure on the trading side to US dollar, to Japanese yen, to the euro, to the British pound. And there's not a lot of options, right? FX kind of has this way of being like oxygen. You're always in it and exposed in some way. And so on the FX trading desks, everybody started hedging into the Swiss franc. And so the value skyrocketed and ended up kind of damaging the Swiss exports. So having a real impact on their export economy. So of course, you know, as history has shown, they pegged the Swiss franc, wiped out a lot of firms. There was a lot of unrest. They ended up depegging it a little bit later, causing a lot of unrest, and some firms went bankrupt as a result. And, you know, being on the technology side of a trading firm at the time, I was just, you know, having a front row seat going, how is this the way global finance works? How is this the mechanism we use for collateralizing all of the trading that we're doing? It's just so fragile at the end of the day, and under the influence of a whole bunch of random governments and elected employees. And so we, you know, at that time, you know, started to form an opinion about, you know, there's a better way to do this, and crypto really has some legs in terms of replacing the underlying rails of the whole system. And so, you know, I think while a lot of others are focused on the kind of speculative trading nature of crypto, I think our focus is on how can this fundamentally change the way we do global commodities trading and collateralizing global commodities trading and reduce risks, make it faster. You know, I think a lot of the you know, offshore exchanges like Binance and Derivitives, for example, have kind of proven out how some of this can work. And so our focus now is on bringing that into kind of a regulated structure where just a whole new level of capital exists, and we're starting to see the tip of the iceberg there with the ETFs. So yeah, we've been trying to keep our heads down, stay under the radar during our regulatory approval process. And then just at the end of 2023, we became the first ever business to be approved by the CFTC to have an exchange license a clearinghouse license, and a brokerage license all under one roof.
And that's to trade crypto commodity derivatives?
Yeah, exactly. It's any kind of derivatives trading in the U.S. So we can domicile in the U.S. We can have international customers come in and trade.
You could trade pork belly futures if you wanted.
We could, yeah, and so something that's not always obvious with the licenses is actually the shorter the license is and the shorter the order designation order is, the more of the Commodity Exchange Act you have available to you. And so we can actually do margin, physically delivered, as well as cash settled derivatives contracts. And that's, futures, options, as, kind of the more mainstream structures, as well as, kind of anything else that falls under that purview.
Got it. So walk us through the go-to-market post sort of getting these licenses under your belt. What's the product suite look like today?
Yeah, so what we did as we got these licenses was we would operationalize them as we would go. So we would build the technology, get the license, operationalize that. So first we got the exchange license and we outsourced the clearinghouse, and then worked with third-party brokers in the commodities derivative space called FCMs. And that's where a lot of the big firms like to trade. They're full service FCMs. They're very robust in terms of risk management and things like that. But at the same time, there's been a lot of innovation and expectations from crypto native, traders, not even necessarily for trading crypto, but just the way an exchange should work. And so then we operationalized the brokerage business to help the other FCMs and offer services onto them to allow them to start to interact with the crypto native aspects of collateral management and trading in the same way that you would go and they would help you manage your physical oil deliveries or your corn deliveries or your interest rates trading complexes. Now we can start to offer those types of services onto the FCMs, the introducing brokers and things like that to kind of expand that ability into the institutional space. At the same time, it also allows us to introduce new features, more real-time risk management and things like that, instead of these kind of longer snapshots that the industry has been criticized for in the past. And then finally, the license we got approved for at the end of 2023 is our clearinghouse license. So that allows us to, instead of outsourcing clearing, take that under our own wing and, start to innovate and bring new technology and real-time risk management to that aspect of the business as well.
So it's obviously quite the Herculean task to go up against CME Group, and many have tried and many have failed, even within our segment, right? Whether it's, your hearts have to go out to Arasex. Really the choo-choo train that tried, from sort of pivoting to crypto in 2017, not really getting any tractions. They had a whole host of licenses that they pontificated about, whether it was their DCM or DCO or whatever alphabet soup they had assembled together. Then to get acquired by CBOE, only for CBOE to then wind that business down. Of course, then there was also Backed that had its listed futures. Didn't go anywhere. That business is all but almost bankrupt at this point. I don't want to be doomy and gloomy, but what sort of is what is the path to victory, so to speak, against such a behemoth in this Luke and Goliath story?
Yeah, let me set some context. I think a lot of people don't realize CME and the global derivatives industry are just massive. I think the U.S. equities markets exchange about, a couple $100 trillion worth of notional volume in trading per year. CME alone does 1.2 quadrillion. So their 0.2 is bigger than the entire U.S. equities market in terms of trading volume. And so it's very entrenched. They do a lot of things right. It's an amazing business. And remember, we have ICE as well, who owns the New York Stock Exchange and a number of the other U.S. equities exchanges. we're talking about a much, much bigger market than people have ever thought about before. There's a lot of focus on US equities because there's a retail component. It's kind of mainstream. But, in terms of global trading, there's a much bigger market. And so I think that's why there's a draw to work on this, because the TAM is so big that even if you capture a fraction of that, you've got a massive business here. I think what makes it difficult for incumbents, though, is that they're kind of hard coded for a way of doing things for the past 200 years. They basically use US dollars and US treasuries as the collateral. And it's just baked in to how everything has worked. We have overnight repo, we have all the news around when the Fed, is lacking overnight repo liquidity, and, everything kind of seizes up. What BitMEX and FTX and Binance and Deribit have done, while there's been some fraud and some issues with it, has still brought some...
Not a Deribit or...
Not a Deribit or yeah. There's others that are okay.
Yeah.
But the point is, underneath all of that, there's a real technical innovation to how the underlying collateral can work. And the focus that's required to bring that to market is just, it's just so laser focused and hard and surgical. You can't just kind of throw some ideas at the wall and see what works, because you're doing much deeper surgery to a much bigger market that's existed for much longer than startups are typically trying to address. So it's not just, a new app that's allowing people to share videos or something. We're replacing the underlying rails of one of the biggest markets in the world. And so that's why you see some failures from some really big players. I think it's also why you don't see many startups in the space at all. It's basically just incumbents. But that's kind of the context for what you're seeing and what you're bringing up. But yeah, it's very difficult.
I'm glad I asked the question, because you sort of laid down, you contextualize something that I think is incredibly important for any watcher or observer of this corner of the market, which is something I've been sort of thinking through these past few weeks, which is the phases of collateral that we've seen in crypto derivatives specifically. And I talked about it on a show yesterday with a guest who was brilliant, but the thought just came out, but it wasn't necessarily pertinent to the conversation. I'm going to try again. I think it is pertinent. I think it's incredibly pertinent to this one, which is the phases of crypto collateral in derivatives. Phase 0 or phase 1 you could describe as being Bitcoin collateral. So BitMEX early on, 2017,
yes, yeah.
2018. Binance gate crashes the industry in 2017, accepts Bitcoin, maybe ETH, I don't remember, but certainly Bitcoin. Sorry, I've already messed it up. Accepting stable coins as collateral and changing the game, right? So you went from Bitcoin collateral to then to stablecoin collateral, as it were. And before we get to this next phase, just to juxtapose it for the audience, I'm sure many of you, most listeners know, CME only cash collateral, which is a big bugaboo for anyone trading in these markets. It's just not as efficient. So to be able to offer stateside alternate forms of collateral is great and a game changer to an extent. But I think, and we can unpack this as well, the benefits of sort of these collateral options. But in the wake, I think, of everything that happened with FTX, we're entering a new era of collateral. Part of which is sort of, and then I'll get off my soapbox in a second, part of which is being hastened by all these new weird tokenized money market funds. And we already saw Athena is going to be accepted as, I think, pairs and maybe as collateral for derivatives positions for Bybit. So I didn't even expect that to happen anytime soon with these new fangled, we can call them tokenized, government debt exposure or whatever you want to call them. But also accepting, this can be almost like the third phase, these tokenized government debt funds. We could see derivatives exchanges like Derivit and others start accepting that as collateral. So you kind of have those three phases, right? It was Bitcoin, then stablecoin. Obviously, stablecoin is the sort of the game in town, the only name in town, as it were. And then maybe we'll transition to this new phase of collateral. And collateral is becoming more robust, right? When you think about the bilateral trading arrangements, we're not just going to sort of take on Luke Coin because he spun it up and now it has some market cap, and it's becoming more robust. There's more options. So I'll stop speaking. That's something that I found interesting. I don't know what the question is there, but maybe you can sort of just take that and opine on the significance.
I think your observation is spot on. I think people look at Binance or what FTX was trying to do, and they actually think that's new. In actuality, CME and other commodities derivatives exchanges around the world do accept a number of alternative collateral structures, whether that's treasuries or gold warehouse receipts or even some blue chip stocks.
Mm-hmm.
There are a number of collaterals that can be accepted. And so what's unique with our business is we accept the US dollar and treasuries as collateral as well. So we have to interact with the entire traditional system. I think that's where some of the offshore exchanges are a bit different. They're just their own system, kind of their own closed system of crypto related assets. What we're aiming for here is not listing the next Dogecoin future for retail speculative trading. It's about replacing the underlying collateral rails and offering portfolio margining on that. And we still have to be selective, right? You still have to apply haircuts to the collaterals that you're accepting, be thinking about the liquidity and the liquidation risk associated with those and what that means. But the problem that we have in the US is nobody's really tackling that and saying, how do we go from treasuries and gold warehouse receipts to Bitcoin, to stable coins, to tokenized treasuries, to maybe some other types of assets and structures. But on the flip side, the cool thing about the US regulatory structure is the rules are principles based under the Commodity Exchange Act. And so we can actually change those underlying clearing rules as long as they meet the principles of the statute. And so that's really what's going on here. I think the US is the right place to build this type of business long term because it's the most trusted, most robust, largest in terms of capital, able to come in and access these markets, regulatory regime in the world. We can still start to bring some of these new ideas in and fit them into that structure. But I think you're spot on that there's a future where we're doing portfolio margining that accepts digital assets in the same way that we accept some blue chip physical assets or securities as well in the current system. And I think the problem is that the technology it's been working this way for quite a while. The operations around it, the way the bigger clearinghouses work with their clearing members, there's a lot of manual procedures and processes in there. So we didn't set out to vertically integrate our business. We were forced to get all the licenses to meet all of the pieces of that onion of market risk management and access so that we could start to make changes to the technology and the risk management, bring more real-time risk management into the system, and start to accept new types of collateral underneath. Long story short, I'm agreeing with your observation. I think that's exactly right.
So then it also raises another interesting question, which is, and I don't want to get too pedantic, I want to get to the rub, why maybe folks who are still listening, who might be peripheral, should care about sort of this issue of collateral. But I want to just dig in a little bit deeper and ask the question of what is it about the client profile maybe of CME that has allowed them to grow a sizable market here in the US with sort of a more limited product offering in terms of collateral? Is there something about those folks that they just don't care? Because I would imagine if they did, they could just do it. I don't know why they don't just do it.
they have all of the clearing members that exist, that have the licenses to have access in the United States. And so while that sounds like a benefit, that can actually be a very difficult and tenuous process to change the rules, because there's so much going on under that rule set, and so much going on with those operations. For example, the big clearinghouses right now are trying to roll out new margin models called value at risk, or VAR margining, and moving away from span, what was originally called span margining, now it's called span one. And so those things take a long time to make, fundamental changes to the risk management systems, even when it's, widely considered the good way to go and the right idea and an improvement. And so they're kind of stuck with, the big bank FCMs and what they want to do. I do think that's starting to change with, the advent of BlackRock and some of the bigger ETFs coming out for Bitcoin. But that's actually a pretty small impact in the whole global commodities infrastructure and how everything works in terms of notional size and volume and the replacement. There has to be a willingness to want to do that. And I think it's just by the book innovator's dilemma. It becomes very difficult to try to cannibalize your own business when you risk, kind of disrupting the golden goose, if you will.
Fair enough. So what's the rub then? Why should average folks in crypto care about these developments underpinning what's happening in crypto derivatives? Because this can, obviously, for folks who are familiar, this is super important to have a healthy, robust, vital derivatives market.
Yeah, let me maybe give a more visceral example. So you probably remember a few years ago there was disruptions to the global supply chain, and lumber prices were impacted. What that meant for individuals is you could go to Home Depot or whatever, try to buy, sheets of plywood or 2x4s, and, prices were through the roof. You couldn't do it. It happened almost overnight. The issue is, as an individual trying to capitalize on those opportunities and trade those types of events, you have to already have your trading account with your FCM, your executing FCM, already funded with US dollars, which means if you haven't, you probably have at best a 3-day ACH or a 1-day wire to get your capital in there. Then your executing FCM has to send those margin funds onto the clearing FCM. And those are some of the bigger banks and things like that have a lower cost of capital for offering, different types of margin fundings and things like that. Then, so that's another best case 1-day wire. Then that firm has to send their capital onto the CME in some form of capital that's acceptable to them. Usually they're doing that in US Treasuries because there's benefits to getting, interest rates and yields on the bulk of the capital that they're holding. So there's other considerations when sending capital into a large clearinghouse like that. So we're talking about a number of, money transmissions that have to occur, if you will, or collateral transmissions, I should say, that have to occur to get your capital in there, spanning a number of days. That's assuming your KYC and everything is already set up and up to date. Everybody's up and running, and it's not night or weekend when banks aren't accepting those types of transactions. By the time you're able to actually place a trade because your collateral is there and ready to go, the opportunity is gone. Okay, what if you had some treasuries that you could send in, maybe short circuit at least that conversion from dollars to treasuries or something like that? Who has treasuries sitting around in some retail account for trading purposes? I'm sure some people do, but it's not as accessible as having a Bitcoin available to send in to the exchange, to the clearinghouse, to the FCM directly. It clears and settles in 10 minutes. There's no risk of that getting reversed. The collateral is there and under the control where it needs to be so that it can be used for collateralization of margin trading. And then you can trade on those lumber price disruptions. So it's really just the velocity of collateral management that's been fundamentally uprooted that has a direct impact on individual traders, trading firms, banks. Who doesn't want to kind of clean up some of the capital that's just, in flow and in process through that whole system, probably to the tune of trillions of dollars per day, just kind of in limbo, waiting to be cleared and settled. Now we can eliminate that. Everybody gets their capital back. They can control it for longer and only deploy it to the exchanges and clearinghouses when they want to capitalize on a trading opportunity.
That makes a lot of sense. And so maybe walk us through sort of how you see this unfolding over the next year. What will derivatives look like, crypto derivatives look like a year from now? If you can pull out your crystal ball, what's the landscape look like?
Well, what we're working towards is still some basic functionality. If you have gold at a warehouse, you can show that to a clearinghouse, and then you can use that as collateral to trade physically delivered gold futures, or write covered calls against your gold. In the case of even Bitcoin, the simplest case, you cannot show a clearinghouse today, hey, I have a Bitcoin here. It is fully covered and I want to write covered calls. That looks like uncovered call writing to the entire system of risk management, and therefore it's one of the riskiest strategies you can be doing, right? So it's this extreme dichotomy. And so what we're trying to roll out right now is the ability for a customer to come with their digital assets, deposit those digital assets against cases where that would just be the deliverable asset in the first place of the derivative that they're trading, and use that as margin collateral. Fast forward a little bit, we can start to extend that into offering portfolio margining, taking haircuts against the more risky assets or more difficult to liquidate assets, and start to really build up an ecosystem like we have in all the other commodities, cheese and corn. Now we start to have that ability in US markets. And so we've unfortunately had to get all of these licenses to allow us to start to bring that technology innovation to the marketplace. Because again, it's very difficult for the larger clearinghouses to, change the rules, replace a whole bunch of technology, test that and roll it out with their 60 plus clearing members that have a lot of money on the line. It's better to do it in a small controlled case where we can isolate out the risk and, test it with the customers that can actually use it, and it has a very high impact for them. But I think long term, why aren't we trading lumber futures collateralized with tokenized treasuries, for example? It would be
or Bitcoin,
right? It could be sent much faster. The clearinghouse can have that cleared and settled immediately versus waiting and having overnight repos, which are effectively IOUs.
But that's the big game changer. That's going to require a lot more than Bitnomial being successful. That's going to basically change. I mean, that's a paradigm shift in markets for people to think about.
It is a paradigm shift in markets. And I think our intention is to force that change and take what we can of that marketplace. Again, we're talking about CME alone doing $1.2 quadrillion a year of trading. It's massive.
It reminds me of that meme, I see on Twitter where people are like, oh, this project's going to make me $1 quadrillion or make up some number. Almost sounds made up. I remember when I first started covering derivatives and was, wrote my first story about CME and was trying to get a sense of volume. I was like, is this a typo? It is massive. It's a massive market.
Yeah, absolutely massive. And the shift, right? I think we see people try to start new exchanges sometimes because they just have a new asset class they want to list, or a new, derivative structure or something. That's good, but that's something that I don't think necessitates a new exchange, a new clearinghouse, a new brokerage. We're fundamentally changing the way this stuff works. And we're trying to capture this massive gulf between what Deribit and Binance are doing, but kind of isolated into the digital assets only realm, and what CME is doing with physical commodities and derivatives and US dollars and treasuries. The gap there is just massive. How do we start to close that gap and just offer some of the benefits of both of those systems on one platform where customers can come and sign up easily and use it? And it's just had a lot of secondary effects as well, right? A lot of the infrastructure that's running is from the 1980s. It's pretty antiquated. There's a lot of manual processing. And when it's done by humans like that, it's very difficult to change because you have to go replace all these manual procedures that are overseen by the NFA and the CFTC, and you got to go do a material change of business to swap that out. It's very difficult and invasive for a pre-existing business to swap that. Whereas if you're coming from a fresh, clean slate with fresh new technology that was built for the modern era, we have things like REST APIs and WebSockets and binary protocols. We don't have people, manually processing paper checks or, accepting faxes. Those types of, it's just our focuses are very different.
Yeah. Once you can we talked about this on the show before, once you can start without sort of I think that's why a lot of firms that try to get into crypto from traditional finance fail is because of all the work of just like weaving crypto into their existing infrastructure. It just takes so much more time than if you just build it up from nothing, because there's nothing in the way.
Let's not forget that ICE had all the licenses and tried to do this with their custodian backed, and it didn't really come together. I think there's various opinions about why that didn't work, but I think what it shows is, weaving that new technology through, like you said, it's not trivial. It's actually a technology play more than it is, a regulatory play at the end of the day. One way I kind of think of it is, okay, now that we start to build all this, is that just now everybody knows? Is it kind of like when somebody first ran the 4-minute mile? We can all see that. And then you start having people, hitting the 4-minute mile mark left and right. No, I think it's more like OpenAI. We can see where they've, gotten and what they've been able to achieve, but the proprietary technology that allowed them to do that is deep and vast. And we're only seeing the surface of the outcome of that black box. And I think that's what's so unique about what we've done here. We've gotten these licenses from scratch on our fresh technology that's completely different and rewritten and changed everything so that we can bring some of these innovations through the system. It doesn't matter what needs to change. It's not outsourced to some third party that we have to pay astronomical amounts of money to get them to change, and it's going to take them 2 years. And it's all this enterprise sales and things like that. It's all the technology is under our control, and it's something that's clean and simple and real-time risk managed so that we can bring these types of innovations to the market.
Is there a future here stateside where we see? It's interesting, right? Because if you think of something like Coinbase International, they were pushed outside the U.S., obviously, hence the name, to offer the products that we've seen be very successful offshore, maybe trying to fill in that FTX gap that has been left behind. Does that ever come stateside? We've seen a lot of these exchange giants try to break in and fail, many from Asia. This was a 2019 story. A lot of that failure had to do with just the market at the time. But, okay, to put a finer point on the question, when are we going to have, a really robust, strong perp market here in the U.S.?
Yeah, I don't think that is like antithetical to U.S. regulation. I just think it's so easy for people, especially when your company's publicly traded, you have to answer to shareholders on a quarterly basis, and they're asking questions about what you're doing and how are you addressing looming competition from offshore competitors and things. It does become difficult to really focus on deeper levels of innovation. But that is not antithetical to U.S. law. The U.S. laws are very permissive. Remember, the CME is the biggest exchange, I think, of anything in the world by notional volume. They operate one matching engine under one regulatory regime in Chicago data centers that is basically accessible to everybody in the world. And at least from the U.S.'s perspective, doesn't require any level of registration or licensure on the traders themselves to come in and do those trades. So we actually have the most accessible and permissive trading regime in the world. It's just that crypto has not converged with that yet. So I don't think building exchanges offshore, if some of these offshore jurisdictions were such a great place to domicile an exchange, we would have seen it, I think, before crypto. And we have seen perpetual derivatives before, certain types of swaps and things like that. They're just not as exciting in those current structures. So I think the really exciting, important thing about perpetuals, for example, is the more frequent and real-time margining and collateralization of those margins. And that really requires crypto, right? It requires a new type of collateral transmission system to make that work really well. So I think that's what the innovation is. I don't think that's antithetical to US law or regulation. It's just that nobody's really pulled that together yet. And that's certainly something that we focus on.
When does this collateral scheme that crypto has pioneered bleed into traditional derivatives markets?
Well, I think one big holdup was that there was just a lot of timidness from risk managers and institutional money managers and things to have access to physical crypto, to ever have an account sitting around, even if they didn't custody it themselves directly, to have an account or a wallet sitting around in their name and title. Because, how do you as a money manager at BlackRock go manage the actual operate, like who's going to go do the wallet transactions at the end of the day becomes a very difficult thing for really large organizations to think about. And I think with the spot ETFs coming online, we've now broken through that restriction. And now I think we're starting to see a lot more is being built behind the scenes by institutions to be able to have exposure to physical markets. And that's what's happening. So on the surface, our business is called a physically delivered crypto derivatives exchange. We have physically delivered futures and options on Bitcoin. Why does physical delivery matter? It's actually a prerequisite to, replacing the underlying collateral infrastructure that we're talking about. It has its own outright benefits as well, and that's the kind of customer base that we focus on today. But it's just a lot of different participants. The institutions that we work with and see are not traditional institutions. It's not banks. It's crypto native prime brokers and dealers and custodians and things that I think banks would normally do in a money or securities world. We have crypto native versions of those. So I think we're going to need to see some of these bigger traditional institutions start to step into those roles before we start to see them use this. And I don't think that that's a short-term thing. I think we probably see that over the next, 3 to 5 years, something along those timelines. And we will probably see more of these types of, kind of big breaks like the spot ETF to continue to push that along. I don't think it's the ETH ETF. I think it's something different where there's a new unlock for the institutional industry as a whole, because the amount of capital that's captive in U.S. markets is just unrivaled.
This is we have the most robust and liquid capital markets in the world. This is the place to be.
It is.
Thanks so much for taking the time, Luke,
Thank you.
and joining the program.
Really appreciate it.
Absolutely. Where can people learn more? Where can they follow what you're doing over there at Bitnomial?
Yeah. Bitnomial.com, at Bitnomial on X, wherever else you're at. We made the name up, so it should be easy to find us.
Yeah, that's funny. Thanks for coming on the show.
Thank you so much for having me.